Hi, everybody. Chapter 7 focuses on two very important balance sheet accounts, cash and receivables. Let's begin by discussing cash and cash equivalents. Cash includes currency and coins, balances in checking accounts, and items acceptable for deposit, such as undeposited checks and money orders received from customers. When we report the cash balance on our balance sheet and in our statement of cash flows, we include cash equivalents with our cash balances. Cash equivalents are short-term, highly liquid investments, readily convertible to cash with little risk of loss. Cash equivalents have a maturity date no longer than 3 months from the date of purchase. Examples might include money market funds, treasury bills, commercial paper. Companies are permitted flexibility in designating their cash equivalents, but this policy should be set free of the intent to fraudulently manipulate the financial statements, and once this policy is set with respect to cash equivalents, it should be consistently applied from one reporting period to the next, and it must be disclosed. You can read an example of disclosure about cash and cash equivalents in illustration 7-1 on page 340 of your textbook. Cash is highly liquid and particularly susceptible to theft, so internal controls over cash are very important. Little review of internal controls. The purpose of internal control is to encourage adherence to company policies and procedures, promote efficient operations, minimize errors and theft, and enhance the reliability and accuracy of accounting data. The Sarbanes-Oxley Act requires public companies to document its internal controls and to assess their adequacy. The Public Company Accounting Oversight Board further requires auditors to express an opinion on whether the company has maintained effective internal control over financial reporting. And COSO, the Committee of Sponsoring Organization, defines internal control as a process designated to provide reasonable assurance regarding the achievement of objectives in the following: effectiveness and efficiency of operations, reliability of financial reporting, and compliance with laws and regulations. You may remember from your Accounting 301 class that there are 7 principles of internal control. A separation of duties is one of the more effective internal controls over cash. There are many internal control procedures, and many of them emphasize separation of duties. In this example, we look at a simple cash receipts process. For instance, Company A opens the mail each day and prepares a multi-copy listing of all checks included in the mail and including the amount and the payor's name. Then Employee B takes the checks along with one copy of the listing to the person responsible for depositing the checks in the company's bank account. And Employee C in the accounting department receives a different copy of the check listing and enters the receipts into the accounting receipts in the books and records. And finally, an entirely different employee would be responsible for preparing the monthly bank reconciliations. Proper controls over cash disbursements should be designed to prevent unauthorized payments and ensure the disbursements are recorded in the proper accounts. Some important elements of internal control over cash disbursements include: all disbursements should be made by check, except for minor petty cash disbursements, and a separate internal control is set over the petty cash system. All expenditures should be authorized, and checks should be signed only by authorized individuals. Proper separation of duties should be employed for internal control over cash disbursements. Here's a question for you. Please pause this video and consider the following question. Which of the following is not an element of good internal control for cash receipts and disbursements? Is it maintaining separation of duties? Is that not a good control? Ensuring all checks are signed by authorized individual? Having the most senior employee handle cash disbursements and bank reconciliations? Or making disbursements with checks rather than cash? So which one of those four is not an element of good internal control? Please pause your video and figure out which the correct answer is. Then restart your video and check your solution. Did you choose C? If not, please take a few minutes to read the explanation at the bottom of this slide. Restricted cash. Restricted cash is cash that has been restricted in some way and is not available for current use. The restriction could be self-imposed by the company's management. For example, management might decide to set aside cash to be used for future plant expansions, or the restriction could be contractually imposed. For example, a debt instrument, such as a bond, requires the borrower to set aside funds, often referred to as a sinking fund, for future payments of the debt. Restricted cash that is not available for current use should not be classified as a current asset. An exception to this rule is a sinking fund contractually imposed on a debt instrument. If the liability is current, then the related restriction on cash should be classified as a current asset. If the debt is long-term liability, then the related restricted cash should also be classified as non-current investment or other non-current asset. Compensating balances are amounts that a bank requires a borrower to maintain in a low-interest or non-interest-bearing account as a condition of the bank granting a loan or extending a line of credit. The required balance usually equals some percentage of the loan or on a percentage of the line of credit amount. The borrower effectively pays a higher rate of interest on the loan because the funds it has tied up in the low or non-interest-bearing account. These are referred to as compensating balances because they indirectly compensate the bank for granting the loan or issuing a line of credit. Here's an illustration. The illustration on this slide shows how a compensating balance makes the effective interest rate higher than the stated interest rate. This is the same example discussed in your textbook on page 342. In this example, the company borrows $10 million from a bank at an interest rate of 12%. The bank requires a compensating balance of $2 million to be held in a non-interest-bearing checking account. The effective amount of money borrowed is only $8 million. the $10 million on the face of the loan minus the $2 million that the borrower can't use. But the $1,200,000 interest is paid on the $10 million loan balance for the whole year. So $8 million divided by $1,200,000 of interest equals a 15% effective rate. Here's another question for you. Please pause your video to consider the answer to the following question. Then once you choose your answer, start the video again to see if you got your answer correct. Jenks borrowed $13 million from a bank at 10% rate of interest. The bank requires Jenks to maintain $3 million compensating balance. What is Jenks' effective interest rate? Do the math. Did you get 13%? If not, please pause your video and review the calculations shown at the bottom of this slide. Well, that's it for this video lecture. In the next lecture, we'll talk about current receivables. See you next time.